So, moving over to everything that is happening this upcoming week, we have a lot going on. So, this week is probably going to be a very hectic week to end the month of August. I actually think the end of August is on Monday next week. So, we'll see how the market makers move things around this week to facilitate their end of month business activity. Last week, taking a look back, finally brought some meaningful relief back into crypto. I don't know about you all, but god damn, this pump felt good. Like, I know that it might not be the bottom, but sheesh, let me tell you what, $500 billion in 3 days felt good. And it was the first time since maybe 2 or 3 months ago that my portfolio finally popped back above seven figures. And it felt good to see those numbers again, just based off of being patient and holding and adding to my position. So we'll see if it continues. But I hope that you all experience the same slight sigh of relief, but we're not out of the water yet. After weeks of aggressive selling, the market staged an impressive recovery as several macro catalysts began working in favor of risk assets, particularly crypto, because Nasdaq was still relatively down on the week overall. The first major catalyst came from the US Treasury's decision to increase liquidity support buybacks for longer dated treasuries, which helped calm a bond market that had been dealing with aggressively rising long term yields. The FOMC meeting in minutes were another important test that we got on Wednesday last week, and they ultimately failed to deliver the hawkish surprise necessary to reverse the improving sentiment. By the end of the week, the geopolitical backdrop also offered a small amount of relief. Treasury Secretary Scott Bessent suggested that the administration's strategy of applying maximum economic pressure against Iran could reduce the need for another major military campaign. Economic confrontation is still negative, of course, for global markets, but from a risk perspective, sanctions are considerably different from another major military escalation capable of disrupting energy infrastructure and sending oil sharply higher. The important point, however, is that none of the major risks have disappeared. The US Iran conflict still remains unresolved. The naval blockade continues. Iran has threatened retaliation against countries participating in Washington's economic campaign that happened over Saturday, and shipping through the Strait of Hormuz remains relatively disrupted still. This leaves markets entering the new week with improving momentum, but an extremely fragile fundamental backdrop. So, for crypto's sake, crypto's recovery has been very impressive. The previous week's low sits right now around $2.1 trillion, dollars, while the new weekly candle opened today above 2.7 trillion, and the total market currently trades around 2.6. That's at time of writing. For now, the fact that the market remains comfortably above the previous weekly low is very constructive. As long as price holds above the $2.3 trillion dark pool, the market has room to consolidate this recovery or potentially continue higher. What I don't want to see or do is mistake one powerful relief rally for confirmation that the entire risk off environment is finished. The rally was helped by falling yields, Treasury intervention, and reduced expectations for immediate Fed tightening. Those same conditions can, of course, reverse very quickly. This week, therefore, will be about determining whether last week's rally can transition from a relief rally into a sustainable higher time frame recovery. For Nasdaq, 29298 continues to tell the story. Nasdaq enters the week in an equally interesting position. Throughout last week, we repeatedly highlighted the bearish pullback down into the dark pool of 29298 as the last major line of defense for buyers. And sellers have now failed multiple times to establish sustained acceptance below it, so this week will be very interesting. You can see how the week ended last week with our bearish target being rejected multiple times. This tells us something very important. You guys can see in the screenshot here, at the beginning of the week last Sunday, we highlighted the pullback down into the dark pool to 29298 as our bearish target for the week. And by the week's end, we came down into that area of interest. And you can see we've respected that area multiple times. So it'll be very interesting to see how the market opens up today. Now, we could simply be seeing sellers take profits when price reaches the 29298, or institutional buyers could be passively absorbing sellers. Either way, sellers have not yet demonstrated enough aggression to maintain price below this level. Friday provided another example where buyers did slightly step back in. Nasdaq finished higher on the day, supported by strong U.S. business activity and continued strength from several major technology companies. This week should give us more information. If the 29298 continues functioning as support, then the recent decline increasingly looks like a higher time frame correction rather than the beginning of a larger bearish trend. However, if sellers finally break below this level with strong bearish price action and acceptance, lower dark pools will likely come into play. So that's something that we'll be paying very close attention to this week is, does this 29298 dark pool hold, or do we start to trade bearishly below it with an increasing risk off appetite? All right, let's go over Nvidia. So one of the biggest events this week will, of course, be Nvidia earnings, which are taking shape on market close Wednesday afternoon, slightly after the New York session trading hours roll over into Asia session trading hours. We will get the Nvidia earnings. So think about it. On Wednesday, we have core PCE and Nvidia earnings. Then starting Thursday, Friday, we have Jackson Hole Symposium. So a lot of the volatility and price swings are, it could go both ways, happen prior to these events where the market prices all the things in that they think are going to happen at these three major impactful events, or we could see a dead Monday and Tuesday and things don't pick up until Wednesday, Thursday, Friday. So be prepared for that. Just understanding when these things are about to be announced, it'll allow you to situationally, represent yourself in the market well this week. The AI trade has remained remarkably resilient because hyperscalers continue spending enormous amounts of capital on AI infrastructure. Microsoft, Amazon, and Google have already provided evidence that cloud and AI demand still remains strong, helping calm some concerns about whether the billions being invested into AI will eventually generate adequate returns. Nvidia this week now becomes another major test of this thesis. Expectations right now are extremely high, particularly around its data center businesses. Markets will be paying very close attention not only to headline revenue and earnings, but also, and what I personally think is forward guidance. Hyperscaler demand, data center growth, margins, and management commentary surrounding the sustainability of AI infrastructure spending. So I don't remember what the CEO's name of Nvidia is, but after the earnings come out, what kind of message does he deliver to investors? Because he's probably going to come out with a speech or make some type of commentary or rhetoric. So what does he say, and what does the market perceive that to be in terms of forward guidance around these things? Strong results and guidance could reinforce the argument that AI capital expenditure cycle still remains intact. That could provide Nasdaq with an independent bullish catalyst, even if the broader macro environment remains uncertain or crypto experiences another pullback. We have to understand that in past cycles, for example, pretty much the entire past 6 months, crypto has been in a bear market, or was it been 8 months? Crypto has been in a bear market. Nasdaq's hit new all-time highs. S&P 500 hits new all-time highs. So if we do see the AI infrastructure thesis continue to prevail, we can't just sit here and continue to expect Nasdaq to sell off as much as of us would like it to, right? If it comes out bullish and supports the Nasdaq thesis and continues to rally in S&P 500, then we have to play that narrative. And if not, of course, the opposite is equally important. If expectations surrounding Nvidia are enormous, a disappointing quarter, weaker guidance, or evidence that hyperscaler spending is beginning to moderate could challenge one of the strongest narratives supporting Nasdaq, and we could continue to see sell pressure. That makes this week's Nasdaq environment unusual. We have macro risk pushing on one direction and potentially powerful AI fundamentals pushing in another. Right now, another catalyst is, of course, the trillion-dollar debt. Last week's Treasury intervention also exposed a much larger issue. U.S. national debt crossed the $40 trillion threshold for the first time in history. And what was crazy is being in America and being out in public and watching normal people walk around like everything's okay, because it's not, right? While the cost of servicing that debt continues rising, markets are increasingly questioning how much debt can be issued without requiring investors to demand significantly higher yields. The Treasury's decision to increase long duration buybacks initially pushed yields lower, but long-term borrowing costs subsequently began climbing again. That tells us that the market doesn't necessarily believe relatively small buyback operations solve the underlying fiscal problem. So the way that I read this, when I was reading the freaking Bank of America report about this, they literally said that this buyback was like a Band-Aid on a big ass wound, right? And when they said that, I'm like, okay, think about why the market's just pumped. If this shit starts to unravel or something doesn't continue, this most recent sentiment in crypto was definitely just a fugazi to liquidate some short positions and for sellers to reposition, and we might see another dump, right? So just, be mindful of that. This week, therefore, I will, of course, continue to watch the 10-year and 30-year Treasury yields extremely closely. You guys will see me talk about it in later reports if anything changes. If yields resume their aggressive climb, financial conditions tighten again, and both Crypto and Nasdaq could then face renewed sell pressure. If yields stabilize or decline, particularly alongside a weaker dollar, that creates a significant better liquidity environment for risk assets and would likely support a continuation of last week's recovery. So you guys see now how many layers there are going to be to this week ahead. That's why I told you guys this shit's important because there's so much about to drop this week. Jackson Hole becomes the main event. You can see here, this is funny. This is one of the little reports that I got from, it was either JP Morgan or Bloomberg Terminal or one of the high impact news platforms that I read. And it says here, all eyes and ears and trading algorithms will be focused on how far the chair goes in summarizing his reaction function and what he signals about both short-term and long-term reforms to the Fed operations, including the dot plot, the frequency and nature of FOMC meetings and press conferences, and broader monetary policy issues. What's crazy is that the Fed chair, I don't remember the number that he reduced it to. I think it's 8 to 6, if I'm not mistaken, but he's talking about reducing the times that the Fed delivers monetary policy announcements from, excuse me, I think it's once a month to once every 2 months or something like that. So I don't remember the exact numbers, but that would be interesting to see how the market starts to appropriate off of that information. So almost wrap this up. Push through me with it, guys. The biggest scheduled macro event this week will likely be the Fed Chair Kevin Warsh's Jackson Hole speech on August 26th. If we go back and we look at historical days in both NASDAQ and crypto, most days where Fed officials have spoken at this event alongside other major central bank participants, we usually see some volatility. Markets have been struggling with the Fed's reaction function. Last week's FOMC minutes provided relatively little forward-looking certainty, and investors largely treated them as backward-looking because the economic data releases since the July meeting have shown cooler inflation and weakness in parts of the labor market. That makes the Jackson Hole Symposium extremely important. The market will be listening very closely for clues about how Warsh balances. So I'm not gonna lie, his name kind of like say Warsh tend to Warsh. Jeez Louise, Warsh. It's like how American people say wash. They say wash. If you're in America, you know what I'm talking about. How Warsh balances several conflicting forces. Inflation remains above target. Oil still remains elevated. Economic growth is showing signs of moderation. Employment data has weakened in places. And geopolitical uncertainty continues creating the possibility of another inflationary shock. Markets don't necessarily need Warsh to promise easier policy. They need clarity that the Fed is not preparing to become significantly more hawkish in the coming data warrants it, if the coming data warrants it. If his comments reinforce the idea that the Fed can remain patient, last week's decline in rate hike expectations could continue supporting risk assets. So ideally this week, keep in mind that right now the market is pricing in, I think, now only one rate hike this year. So from where we currently stand, let's just throw up a hypothetical here. Okay. If he comes out and says something that's extremely hawkish and the rate hike odds increase where the market stops pricing in just one rate hike and instead starts pricing in two rate hikes, right? Or a increased probability of one Fed rate hike. So maybe the odds are at 60% of one rate hike. And by the end of the week, we see those odds at a 90% probability of a rate hike at the end of this year. What do we think the market sentiment could be like? It's not guaranteed, but somebody tell me what, in terms of risk assets like crypto, we could see.
A crash.
I wouldn't necessarily a crash, but yes, we could see a bearish price action reaction from that. Whether it's consolidation or a crash, we know that if we see the market start to price in an increased probability of a Fed rate hike, we're probably not going to see the market rally continue this week, right? It's just logic. Like if we see the market algorithm start to see that the Fed's still in a position to possibly hike rates, then they're going to refrain from taking a bullish bet. Now, I wouldn't say it's going to resolve in a crash, but could we at least see consolidation or just sideways price action or profit taking from last week's bullish event? Absolutely. What we do know is that all the people on the internet, if we see an environment like this that are still telling you that prices are going to go higher and that markets are bullish right now, if we start to see the sentiment deteriorate, we know that that's not going to be the likely outcome. And all the bullish moon boys are just lying for views, right? So you use this information to your advantage. Good job, Camille. That was a great response. Don't ignore the labor market revisions as well. I know that this is kind of some like underlevel surface information that I'll make sure to detail for you guys in the report, but we have labor market revisions coming up. Another event that I'm watching closely is the preliminary benchmark revision to payrolls. This could be more important than a normal employment release because recent payrolls have already raised questions about the true strength of the labor market. Last year's preliminary benchmark revision eventually translated into enormous downward adjustment. And so, another reason why I'm paying attention to this is because what I'm noticing is that in 2024, in August, we had these revisions and they came out downbeat. And that's what allowed the market to start to price in that in September and October, we were going to get rate cuts in 2024. Then the market started reversing bullish because it saw the deterioration in the labor market, started supporting risk assets under the premise that the Fed was going to ease monetary policy. Then come September, when they actually eased monetary policy, the algorithms already bought. When they eased monetary policy, if you go back and you look at that day, you would expect the Fed to cut rates, support risk assets. But on that day, profit taking from all the August buying happened, and then price pulled back. And all the retail traders were trying to figure out why there was a $100 billion down day. And it was because the market algorithms already bought the month before because they started pricing in the rate cuts. So when the rates actually were cut, it was a buy the rumor, sell the news event, right? So, anyways, another reason why I'm paying attention to that, because if we see significantly weaker or fewer jobs than originally reported, then the market's going to start to lean towards a Fed that's not going to have to hike rates, which could support the easy monetary policy backdrop, or at least not put rate hikes in the immediate vicinity, right? Which is supportive for liquidity. Also, on top of all this, holy crap, we have PCE inflation. Alongside personal income and spending, we have GDP related data this week, consumer confidence as well, and we have Fed surveys along with a weekly jobless claims. The market already has CPI and PPI, so this week PCE may need a meaningful surprise in either direction, either to the up or downside, to dramatically change expectations. If we see the core PCE this week come out at what the market's already expecting, it's probably not going to have that much of a price impact outside of continuing the directional bias. So ideally this week we'll be looking for major outbursts either to the up or downside in PCE. If inflation continues cooling while the labor market gradually softens, the argument for another Fed rate hike becomes increasingly difficult to justify. But this is where the Middle East becomes critical. Cooling backward-looking inflation data means much less if Brent oil remains above or around $90 to $95 and energy prices begin feeding into the future of inflation. Markets are always forward-looking. They're not simply asking where inflation was last month. They're trying to determine where inflation will be several months from now. And that makes the Strait of Hormuz one of the biggest variables in the entire macro picture. So to wrap this up, Iran has now warned that countries participating in America's economic campaign could be treated as enemies. Iranian officials have also threatened that if neighboring countries cooperate with Washington, energy exports from the Gulf could face further disruption. That, of course, creates obvious tail risk. The bullish development would be simple. If we see renewed negotiations, de-escalation, improving shipping conditions through the Hormuz Strait, and falling oil prices. That combination would improve geopolitical risk premium for energy while simultaneously reducing future inflationary concerns. The bearish thesis still stands. Any developments on attacks, sanctions, retaliation, disruption of alternative shipping routes, or direct military escalation would, of course, decrease appetite for risks, and we could see a major sell-off or price retracement, especially in crypto. Another thing that I'm being mindful of that has popped up back on our radar. Does anybody remember back in, like, let's say February to April timeframe of this year, one of the major fundamental catalysts that we were constantly going over on these Zoom calls? Does anybody remember? And it kind of disappeared as the summer started. Anybody remember?
Was it the yen carry trade?
No, not yen carry trade. Still good idea. Something else that happened in the beginning of the year, February, and then kind of died out.
All right, one more guess is the tariff situation.
Tariffs, right? Beautiful, Eric. It
Okay.
was the tariffs, right? Remember all at the beginning of this year, we had a bunch of tariff scares, a bunch of freaking tariff threats and tariff war jargon, right? I literally remember reports talking about Mexico, freaking UK, Australia, tariff announcements, India, all the time with freaking reports that I was giving you guys in the beginning of the week. And it was one of the catalysts that weighed on market sentiment, especially risk assets at the beginning of the year in 2026. And for the longest time, we had mentioned that all these 90-day, 180-day trade negotiation talks would pick back up at the end of the year near and as we get closer towards elections and the end of the year in Q3, Q4. And now we're here and we're starting to see the tariff narrative come back into play. So just recently we saw major headlines between US and Canada, which is actually it could spiral into something that's not positive for risk assets. So I'm bringing it to your attention in case this week we see it escalate. So right now, we are also watching US Canada trade tensions. After negotiations this past week failed to produce meaningful agreements, the US imposed 50% tariffs on roughly $20 billion of Canadian goods, and Canada has already signaled that it is prepared to retaliate dollar for dollar. And if we remember, just based off of historical data, do you guys remember when all these tariffs were announced last time and things started to get crazy? What did the market start to price in?
Was it risk?
It's well that, but it started to price in higher inflation. Higher
Mm.
inflation requires that the Fed might have to hike rates, which we know tightens liquidity, which is not good or supportive for risk assets. So again, bringing it to your attention, if we see any announcements this week that Canadian officials are looking to retaliate or escalate the situation, and they don't come to some mutual agreement about bringing these tariffs down, it could be something that starts to weigh on the market sentiment and the forward-looking outlook. All right. So to finish this off, last two things. For last week's recovery to continue, very plain and simple, here's the rainbow scenario. I want to see several pieces start to work together. Ideally, and this is again the rainbow Goldilocks scenario, which we hardly ever get, but man, this would be ideal, and this probably create the biggest bull run in crypto's freaking history. If inflation remains contained, if labor data starts to show gradual cooling without signaling severe economic contraction, if Warsh avoids introducing any major hawkish surprises at Jackson Hole, if treasury yields continue to stabilize or, more preferably, decline, the dollar remains weak and oil begins moving lower because Middle East tensions ease. That would be like literally the ideal scenario. On top of that, strong earnings reports from Nvidia and guidance that is forward looking that confirms sustained hyperscaler and AI spending. If we could see that, then this week we'll probably see Nasdaq bullish, probably see crypto bullish. I mean, literally, if we got all those things and the stars aligned, and then on top of that, if something positive came out with the Clarity Act, which I don't think it will, but man, that would literally be like a freaking angel from heaven coming down and saying, flap your wings, risk assets, because y'all are about to fly, right? So putting that on everybody's mindsets. So picking apart this week, these are some of the things that could create bullish pumps intraday versus the next day seeing the sentiment flip flop if the sentiment reverses. But these are the things for the bullish scenario that we're going to be looking for this week. Bearish scenario, of course, just turns this on its head. If Iran retaliates against America's economic campaign, Hamas disruptions continue to worsen. Oil pushes substantially higher above or stays relatively above $90 to $95 per barrel. Treasury yields resume climbing. The dollar strengthens and Warsh reinforces the possibility of additional rate hikes. The markets, of course, could quickly unwind some of last week's optimism, particularly in crypto. And we know Nasdaq has been relatively suppressed, so we'll be looking very closely at the AI narrative. That means if Nvidia disappoints or signals that AI infrastructure demand and hyperscaler spending are becoming too slow, then we could definitely see Camille's catalyst as she's predicted of a huge crash in Nasdaq, right? So let's be mindful of these things, guys and gals. I'll make sure to send this report out so that each of you all can digest it yourselves, take from it what you will throughout the entirety of the week as we get closer to these events. You can always come back to the beginning of the week report and just kind of go over, okay, Wednesday we got Nvidia and we got core PCE. So let me go find in the Sunday report just to kind of remind myself ideally what I would like to see today and kind of see how the data comes out. Boom. At 7:30 in the morning, the data comes out. That's an hour prior to New York session. I'm going to be up analyzing it. You guys will get my morning briefing, but at the same time, on your own time, read how the data came out, read it what the Sunday market print said, and then just kind of go off of, wow, okay, I see this. I'm at a delta. I'm seeing some bullish price action and some order flow, and the sentiment looks like it's supporting risk. Okay, today I'm going to look for buys until price starts to show me otherwise and we break this structure and sentiment starts to deteriorate, right? So that way you align yourself with the intraday environment. All right. All right, so that's all that I have for you guys in terms of this week's update. Like I said, it was a complete mouthful. I get it, but I feel like as your mentor and as somebody who just tries to my best to really align the people that care in this community about maturing in their investing career, I feel like there's never been a day where we don't know what the heck's going on versus everybody else that's out there is like ripping out their hair and watching freaking all these people on Twitter talk about, oh my gosh, like could you imagine the retail sentiment right now where I was watching this one guy, his name's Bull Theory on Twitter or whatever, and he was like, "Oh, market pumped 500 billion, but now it's down 10 billion. Who would want to invest in this market?" That's what he said. And I'm like, who wouldn't? Like that shit sounds fun to me if you understand what you're doing, right? So I love that you guys join me on these calls and I really enjoy writing these reports for you all. Not only does it keep me aligned and keep me accountable for what's happening in the market, but I like feeling like my team knows what's going on. There's hardly ever a blind moment, whether it's myself, Mr. Man, or in the past, people like Codius, excuse me, or Walker, who have been updating you guys with fundamentals, or Michael too, as well in his fundamental section. We're always fine tuned with what the breadth and the depth of the market and what's happening is. So I hope that you guys have enjoyed. Um, I'll leave the floor open if you guys have anything on this front. You want to discuss any of these topics that we just covered today, whether it's the fundamentals or this report. If not, I'll see if you guys want to stick around for any Nasdaq breakdowns. If you guys have any trades you want to go over. If not, then we can roll over into tomorrow. We can have another Zoom call tomorrow and we can enjoy the rest of our Sunday. Up to you all. I'll leave the floor open.